Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Jonathon of Apollo Global Management to talk about the investment opportunities in private markets. Hello, Jonathon. Welcome to the studio. Firstly, could you give us some background to Apollo and your own experience?
Sure, thank you. Delighted to be here. Thank you very much for having us. Delighted to talk to Wealth Club about the exciting opportunities we see in private markets. Very briefly myself, so I'm Managing Director in the Client Portfolio Management team based here in London, covering clients across Europe and Asia for wealth-oriented products. More importantly, who are Apollo? So Apollo are one of the largest private asset managers in the world, roughly $600 billion assets under management, and we cover the full spectrum of private markets, private equity, credit, real assets, frankly, anything in between. We're very much a value-oriented investor, very focused on downside protection and risk mitigation. And we really have three core tenets of how we think about investing. One, purchase price matters. So we'll not chase hot markets. We're not kind of chase ever increasing valuations, very focused on that downside protection and that entry point price. Two would be excess return per unit of risk. So across the risk spectrum, our job is to deliver an excess return for that unit of risk a client takes. And last but definitely not least is alignment. So we are a very big investor in our own products. Of that 600 billion assets under management I mentioned, roughly half is our own balance sheet. So we're side by side with our clients, often the biggest investor in our own funds.
And we're here today to talk about private markets. Firstly, what are they?
That is a great question, because I think there's a lot of confusion and natural concern across wealth investors around private markets, and alternatives more broadly is how I'd characterize it. Private markets being a subset of that. I think the confusion is valid. There's a lot of different alternative solutions out there, so that creates the confusion, but also the concern is that they're complex and risky. And I think that is very true in some cases, but not necessarily universally true. So at Apollo, we define an alternative as very simply an alternative to a publicly traded stock or bond, where we're seeking to deliver that extra return in exchange for giving up a little bit of liquidity. So private markets are inherently illiquid, but we think that actually creates an attractive proposition for clients. What I say there is you can get a better risk-adjusted return, potentially, in terms of the overall return, but also the downside risk mitigation, lower volatility, in exchange for liquidity. That is often a big concern to a client, giving up that liquidity. Historically, private market products have been very much drawdown structure long-term, so you're locking up 5 to 10 years perhaps. Recent market innovations have created products where that liquidity can be more frequent. But also, I think investors need to think about how much liquidity do they need tomorrow? Do you need all your capital available on demand? Or could, in exchange for a better risk-adjusted return potentially, could you give up a degree of liquidity within a broader portfolio to diversify? And we see that very, very much in the wealth markets today in terms of client interest.
And so private markets have been growing in popularity amongst institutional investors. What's driving this trend? And is it continuing with higher interest rates?
It absolutely, I'd say on the institutional side, very generally speaking here, it's slowing down a bit because they were first to market. They saw the opportunity, they entered in size, and in many cases, not all, many cases are at scale. Actually, I see the forward growth much more significantly in wealth investors. That's what we see on a global basis today. So yes, institutional demand is very much still there. It will continue to be there. Will it grow exponentially? Perhaps not. The growth area actually is in wealth markets. Why did institutional investors move into private markets earlier? It's for the reasons I was just saying. That risk-adjusted return, lower volatility, potentially excess return over time within a portfolio because they can give up some degree of liquidity. And in a balanced portfolio, in a diversified portfolio, where perhaps some is very, very liquid, not everything has to be. And I think institutional investors were very quick to see that opportunity to boost their returns. Wealth investors are now seeing it. And again, as I mentioned, part of that is because of kind of the new products that have come to market that have kind of allow for some degree of liquidity, more than what was seen in historical private market funds.
And where are you seeing the most interesting opportunities in private markets at present?
That's a very good question. I think because we cover the full broad market and given our scale and our size on a global basis, we actually see opportunities everywhere. If you were to push me right now, what is top of the tree in terms of the best opportunities, Private debt, most certainly. Large cap lending is a very attractive proposition in this environment with these yields. I'd also say secondaries, so the ability to buy and sell products that have already existed from GPs or from other LPs. That's a market that is growing. Climate transition related investments, most certainly, is an area. And asset-backed financing, they'd probably be the top. But again, we do see opportunities everywhere, given the scale that we have.
And what characteristics are you looking for within private markets?
For us, and again, private markets are very broad. For us, I mentioned earlier, value-oriented investors. So we're very focused on that downside protection. So what is the leverage inherent? What is the earnings multiple we're paying? What is the risk mitigants within it? What is the cash flow that's being generated on a constant basis? What are the stress scenarios that could impact the business? Those are key tenets across our business. It's not asset class specific, but that we focus on when investing in private markets.
And so, finally, Jonathon, just to sum up, why should a high net worth investor consider investing in private markets?
Sure. And again, a great question, and I think it's the one we get most often, quite frankly, when I talk to clients on a global basis. It's around that diversification. It's around that potential for risk-adjusted returns to diversify your portfolio. A lot of public markets are very highly correlated, have inherently become beta. Okay, and so that was fine in a zero interest rate environment when basically everything was going up. We're not there today. And so I think if investors look forward, how can they achieve the returns they've been used to or they strive for in their portfolios? Private markets can, in a broad diversified portfolio, offer that differentiation, that diversification, and a different way to access a risk return spectrum that is aligned with their investor needs.